Katie found Barron's Best Fund Families, which brings us to our video for today. Investing with the best cost investors millions. What did the report show? It showed that in 2011, Delaware Management fell from number 1 all the way down to 49 out of 62, meaning the bottom 20% of fund families. Meanwhile, Putnam, which was 58th out of 59, in other words, the bottom of the barrel, catapulted all the way to number 1 in 2012. Why this huge movements in the rankings? It's because there is pure statistical random luck with how these fund families actually perform. But there's real meaning to you, the investor. Let's assume that you use track record investing to place your money with active managers. We looked at a 10-year period, 1991 through 2001. That's a 10-year period where we took the best 30 performing mutual funds, and they outperformed not only their peers, but the benchmarks by substantial margins. If you invested in those 30 funds, were you rewarded or were you penalized for using the cream of the crop? Well, the following 10 years, you were actually penalized for using those best 30 funds. And not by a small margin. You can see here it's somewhere between 2 and 3% per year annualized of a penalty. Our investors know that 2 to 3% compounded over long periods of time is a significant consequence. In fact, the difference between 7% growth and 5% growth on $1 million compounded over 30 years is a $3.2 million difference, which is the difference between running out of money or not. So you see this on the mutual fund prospectuses where it says a fund manager's ability to pick stocks and outperform in the past has zero correlation with their ability to do so in the future. It's because of pure statistical random luck when they do, and they will revert back to the mean. And on average, active management must go back to the mean minus their fees. So what is the lesson for today? The lesson in Meaning for Investors is the only way to win the active management game is to not play. That's why we at Financial Harvest Wealth Advisors use a passive approach, using market structured funds to be globally diversified, avoiding the penalty and the high cost of active management so that you, the investor, wins. Remember, your financial survival is on the line. Use a fiduciary.